John, we're trend followers here, and you're talking a lot about these trends. So when the trend is so short, what do? How do you make money in that environment?
We stick with our models. CEF model for the past 4 years. First year, I think it outperformed the S&P by 3%. The second year, it outperformed by 22 or 23. The third year, which was the major downtrend, we caught the move in energy, that whole big. If you recall that move, that was basically mid-January to mid-June. The money went there, according to our model, stayed there for 5 months. So we outperformed by 27 or 28%. Last year, we were relative performance. We were dead even with the S&P. So I think if you're using a model and you're comfortable with it, especially you're comfortable with the risk parameters, your betas are right, and your maximum drawdowns are something that you're comfortable with, you can't. If you start trading your own model, you're not going to make any money. You do the work to back test your model and understand that you're not going to have a nirvana kind of an environment all the time where your model is going to flourish. Right. The game is over time. How does this thing do over time? And we've got a couple of 2-3 different models. We blend them together and we back test them as sets where you might be 30% in this model and 70% in that one. See what the risk reward numbers look like that, and we blend them for clients. And I'm a lot more comfortable than trying to chase the tail of the S&P 500. I find things that have worked over a 5 to 7 year time period, and we stick with them and understand that as the market goes through its different cycles, sometimes it's in an uptrend, sometimes it's in a downtrend, sometimes it's sideways. Over time, by making logical, data-driven decisions, I think that's the only way to play this game. I really do.
Yeah, I mean, I think that's actually just like, even from a bigger picture and conceptual kind of view, I think what you said is very important. You did your back testing, you did your studies, you found out something that worked for you, and you're sticking with that. Much like we have our own view and we have our own methodology and we stick with that. And in the end, as Justin mentioned earlier, we'll kind of end up in the same conclusion, but maybe we've taken different paths to it. So it's that consistency, and especially once you find something that works. A lot of people will just kind of go from strategy to strategy to strategy, and they never kind of develop that expertise to develop the sensitivity how markets can change and adapt in different environments.
Yeah, I think a parallel to that is when you look at investor sentiment, right? Investor sentiment is really bullish at the top.
Yes.
And then it's a fire drill to get out. And then it's really bearish at the bottom, and that's where the opportunities lie. I think human nature drive these markets. How we react to fear and greed as a huge group of investors together, those are the buttons that are in our DNA, right? We're either really fearful or we're really greedy. And people tend to ditch a strategy. You might be in a different period like this. This has been a pretty unusual 6 months. They'll say, well, I'm not going to use this anymore. It's kind of like when you throw in the towel at the bottom, right? And then you're saying, oh man, now what do I do? And so whenever you let the market push your buttons like that, I think you're dead meat. I think you really need to have a strategy that has to do with data, has to do how something has responded to the market over the past 5 to 7 years. This past 5 to 7 years have been great, right? We've had a pandemic. We've had a major uptrend. We've had a major downtrend. We've had a shift from a zero interest rate policy back to a little bit more normalized interest rate. There's a lot of stuff that's happened in the past 7 years. It's a great chunk of data to use for a back test.
Yeah.
Mm-hmm. Yeah. You have another way of looking at some of these sectors that I wanted to kind of have you share with our listeners, and that is kind of what you call the rainbow charts. So I'm going to pull. We can pull up the XLK right now, which, as you mentioned, has been the best performing sector spider fund of the year so far. So how do you use this rainbow chart to kind of tell you what's happening here?
This is a component of our CEF model, which is a part of our services that we offer. And we also, we manage money with this model. But we had the chart, kept it internal for a while. I wanted to be able to look back a year and just see the relationship between what the model is telling us and what the market's doing. So what we have on top, favored is green and neutral is yellow and avoid is red. And down at the bottom, this is XLK up at the top. Down at the bottom is a corresponding relative performance chart between XLK and SPY. So you can see on May 15th here, the last quarter of the chart on the right, on May 15th, it moved into favored status. It got stronger, and then it had a quick dive here into neutral on June the 4th, and then it quickly came right back up again. So during that period, since May 15th, we've had 4% of relative outperformance in XLK. That's what we're looking for. But what's been odd this year, take a look at this dive from basically, looks like the middle of March, and then we collapse all the way down into a void, the weakest that we could have, which would be a ranking of 33. That's the lowest it can go. And then and look what happened in the meantime. We had relative underperformance here. And then as soon as we bottomed out here on a void and started to move higher, we had an even bigger move up. But these types of choppiness is something that you don't normally see. What you'll normally see is like what we have here from October of last year to roughly December of last year. We had this sustained period. This is about a third through the chart up top, where it was up in the green and stayed there, and it gave us this big move. So all we're doing here, we're not predicting, we're not trying to forecast where the the economy is going to go. We're chasing the money, and when the money finds a place that it likes, it stays. You get one or two of those sustained moves every year, like we had in energy, during the major downtrend, and those make your year. Is finding those places where the money goes and the money sticks, and this shows us kind of what it's doing.